Most people focus on the moment the decline becomes obvious, the auction that flops, the price chart that dips, the collector who panic sells. But the real story doesn't start there. It starts the day after the peak. Today on Collectiblepedia, we're looking at what really happens after a collectible category reaches its high point. When headlines fade, speculation slows, and long-term consequences quietly begin. Because decline never starts with collapse. It starts with subtle shifts, and if you're a collector, investor, or enthusiast, understanding the day after might be the most valuable skill you'll ever develop. Let's start with the moment everyone remembers. Think about the height of the boom. It could be a record-breaking trading card sale, a comic book hitting 7 figures, a vintage watch doubling in value, a coin category exploding in auction. The headlines were everywhere. Auction houses were celebrating, YouTube influencers were hyping, forums were buzzing, prices were climbing weekly. Why did it feel right? Because demand was visible. Prices were rising consistently. Media attention reinforced the narrative. New buyers were entering daily. The assumptions people made, this is the new normal. Supply is limited. It's only going up. I'll regret not buying now. At the time, this decision made sense. Momentum creates belief. Belief creates action. Action creates higher prices. And higher prices reinforce belief. No one buys at the top thinking it's the top. The day after, things still look fine. Here's the part most people miss. The day after the peak, nothing dramatic happens. Prices don't collapse instantly. Collectors don't panic immediately. Auction houses don't announce trouble. In fact, the short term often feels calm. There may even be small wins, a strong sale here, a bidding war there, a social media post celebrating another high price. People believe the decision worked. This is important. There's no villain here. No stupidity, no incompetence. It's simply momentum coasting. Markets don't turn on noise, they turn on quiet shifts. This is where the invisible shifts begin. Now the subtle changes. They're small, almost unnoticeable, but they matter. 1. Behavior changes. Fewer new buyers entering, existing collectors becoming selective, more listings appearing quietly online. New pressures. Sellers who bought high needing liquidity. Increased grading submissions flooding the market. Speculators exiting once quick profits slow. Small compromises auction reserves lowered slightly. Buy it now prices adjusted. Sellers accepting offers they would have rejected weeks earlier. 4. Early trade-offs. Quality becomes more important than hype. Scarcity narratives get questioned. Long-term collectors stop chasing every release. None of this makes headlines. But this is where decline begins. Not with collapse, with hesitation. The consequences don't arrive loudly, they arrive slowly. Months later, something feels sudden. Prices down 20%. Auction sell-through rates falling. Graded populations revealed to be larger than expected. People say, what happened? Why did it crash? But nothing broke overnight. It compounded. Lower demand plus more supply plus reduced urgency equals downward pressure. The compounding effect makes decline feel dramatic later, even though it began quietly. That's the dangerous illusion. Decline feels sudden, but it was gradual. Most people don't ignore problems, they simply don't see them yet. Let's talk psychology. Cognitive bias. We anchor to peak prices. Overconfidence. If it recovered before, it will again. Emotional investment. Collectors love their items and love clouds judgment. Process blindness. Few people track sell-through rates. New supply growth, buyer participation, market liquidity. Organizational inertia. Auction houses and influencers rarely sound alarms during transitions. There's empathy here. It's hard to see decline when you're inside momentum. People with experience don't judge decisions by the moment they're made. Seasoned collectors ask different questions the day after the peak. Are new collectors still entering? Is supply increasing faster than demand? Are strong sales broad or concentrated in ultra-rare items? Are mid-tier items softening first? They monitor bidder count, time to sale, discounting behavior, population reports, dealer inventory buildup. They expect behavior to change. They understand cycles. And most importantly, they separate passion from price. That's maturity in collecting. The lesson isn't don't act, the lesson is plan for the day after. Here's the mindset shift. When buying into a hot category, ask, if growth slows next month, does this still make sense? One framing principle, collect for durability, not momentum. One long-term question, if I couldn't sell this for 5 years, would I still want it? That question changes everything. Most collectible categories don't fail at the moment they peak. They fade in the days, weeks, and months that follow. The day after decline begins isn't dramatic. It's quiet, and that's why it matters. If this changed how you think about collectible markets, that's the goal. This is the day after. And next week on Collectiblepedia, we'll explore the day after hype goes viral. If you value deep insights into collectibles, market psychology, and long-term collecting strategy, like this video, subscribe to Collectiblepedia, and join us as we explore the stories behind the objects we love. Because in collecting, the real story always begins the day after.